From Deloitte Tax, welcome to the Tax News and Views podcast. In this podcast series, we talk to specialists from Deloitte about the latest business issues and developments. I'm Carrie Falkenhayn, your host for Tax News and Views, and today's topic is the Passthrough Entity Tax. While pass-through entity taxes existed before, we have seen more states enact PET legislation since the Tax Cuts and Jobs Act limited deductions for individuals of their state income taxes. Each state has its own nuances, so consideration needs to be made whether these rules are beneficial to the partners in any partnership and whether the impact might be different to different groups of partners. Joining me today to share their insights are two multi-state tax specialists, Daly and Jason Kang. So to get us started, Jason, maybe you can talk a little bit more about what a pass-through entity tax is and why a pass-through entity might make the election to be taxed that way.
Carrie, as you alluded to, the Tax Cuts and Jobs Act limited the state and local tax deduction to $10,000. And so in reaction to that, a number of states initially tried enacting a charitable contribution workaround, wherein individuals could make contributions to a charitable fund that would fund the types of services provided by states that would ordinarily be funded by tax revenue. And in exchange, the taxpayers would receive a tax credit or a benefit when they filed their personal income tax return in that jurisdiction. Treasury said that to the extent that a taxpayer received a tax benefit for a charitable contribution, that the charitable contribution would be disallowed on the personal income tax return of the taxpayers. The next wave that we saw after that was that states enacted these pass-through entity taxes, wherein a pass-through entity would make an election to pay an income tax at the entity level, even though ordinarily a pass-through entity tax is flow-through in nature and is not subject to tax at the entity. By making this election, the entity pays this income tax, takes a business deduction with respect to that income tax, thereby lowering the distributable income to each of its partners or shareholders or members. As a result of that, the shareholders, partners, and members of flow-through entities will have lower federal taxable income and therefore pay less federal income tax with respect to their income from that flow-through entity.
It's almost as if they got the deduction.
That's right, Carrie. Because their income has been reduced, it's as though they've received the full deduction with respect to the state and local taxes paid by the pass-through entity, rather than being limited to $10,000 at the shareholder, partner, or member's personal income tax level. Now, we saw an uptick in the number of states that have enacted these taxes. If you look back at towards the middle of 2020, there are about 6 states that had enacted a pass-through entity tax. And it was really when Treasury issued Notice 2020-75 that it really resulted in the number of states that have enacted these types of taxes to really skyrocket.
Has there been any guidance in terms of what qualifies under these new regimes?
Yeah, Carrie, when Treasury issued Notice 2020-75, prior to the issuance of the notice, there were a very limited number of taxpayers that made these elections because there was a lot of uncertainty as to whether or not the IRS and Treasury would disallow these types of deductions, similar to how they had disallowed the charitable contribution workaround that I referenced earlier. And as a result of that, really not many taxpayers availed themselves of the benefits of these pass-through entity taxes. And under Notice 2020-75, the deductibility of these types of taxes, and they've indicated that Treasury will be issuing regulations that further discuss the deductibility of these types of taxes. We haven't seen those regulations as of yet. And so it's unclear at this point, whether any or all of the types of state pass-through entity taxes that have been enacted will be deductible, because we have seen that there's a lot of variability between the different states that have enacted these taxes. New York and California, for instance, allow for all of the income of the partner, member, or shareholders to be included in the tax base, whereas non-resident income is apportioned using the entity's state apportionment factor. And we've seen a number of different states have different rules with respect to whether or not you pay the pass-through entity tax on partnership members or corporate members, et cetera. And so until we see regulations from Treasury, I think there's a little bit of uncertainty around the deductibility of these types of taxes.
Okay, got it. Dan, maybe turning to you, despite this uncertainty, who should consider making a state pass-through entity tax election?
Hi, Carrie. Thanks. So generally, all S corps and entities taxed as a partnership are eligible to make the election and should be considering this. However, of course, each state has its own set of PET rules and requirements to carefully consider. Not every pass-through entity, unfortunately, can qualify to make the election in every state. So, for example, in certain jurisdictions, having a partner that is a partnership disqualifies the entity from making the election. So some pass-through entities with non-qualifying partners have considered amending their partnership agreement or doing restructuring to allow them to qualify to make the election. Obviously, that would be a lot to analyze in restructuring, but something to consider. By restructuring the partnership and allow the partnership or pass-through entity to qualify for the election. Also, originally, a lot of the focus was on partnerships in a trade or business, generating ordinary income. Think your Main Street businesses operating maybe in only one state or 2 or 3 states. Those businesses should clearly be looking at this for the potential benefit of making the PET election. However, as Jason was describing, notice 2020-75 gave us more guidance. It was short on detail, but it included what the term specified income tax payments, which is broad enough in the notice to allow a partnership level deduction for pass-through entity taxes imposed on separately stated or investment income. Meaning, investment partnerships, as well as operating partnerships, should be considering the PET elections, though there can be differing treatments between the two that you'd want to discuss with your tax advisor. The PET implications can be complex, but generally, again, all entities taxed as a partnership and an S corporation or an S corporation should be having a discussion with their tax advisors to look at the potential benefits.
Okay, Dan, so you shared with me who is eligible to make the election, but does every state have a pass-through entity tax?
So not all states have a PET yet. However, there are a lot. Currently, there are 20 states that have enacted a form of PET in various iterations. Of course, not every state's enacted it in the same manner. Some of these jurisdictions tax residents on their full share of income, while others only include the PET tax in the PET tax base, the state source income determined by the partnership for resident partners. So there's definitely differences. Another example, some of the PETs include corporate partners, while others exclude corporate partner income from the PET tax base. So while many states have enacted similar PETs, unfortunately, there's no standard set of PET rules. The good news, though, is that many of these are applicable for tax year 2021, making the option available right now for pass-through entities to consider electing into. There is a lot to work through and consider before year end, though. There are considerations for timing of making the election and making the payment in the current tax year, because each state's going to have different rules around that. But this is a potential opportunity for most companies, and we highly recommend starting the conversation as soon as possible to get the ball rolling.
Okay, so are there any special considerations that our listeners should be aware of, Jason?
Carrie, there are quite a few considerations and complications that listeners should be aware of when contemplating whether or not these pass-through entity tax elections are prudent. The greater the complexity in the partner base, there are a number of different complications to consider. First, you have to look at what your partner base is, or your partner member or shareholder base is, whether they include trusts, partnerships, corporations, individuals. And in addition to that, you also have to consider the residency of the individuals and trusts that are involved. There are, generally speaking, credits for taxes paid that your partners and members can claim with respect to these pass-through entity taxes. They can claim those as credits in their state of residence as a reduction to their resident state tax. However, there are a number of states that would treat an entity level tax paid by the entity as being a non-creditable tax. And therefore, to the extent that you have partners or members who are resident of these types of states, it could in fact be a detriment to them, even when factoring in the federal benefit, if they lose their credit in their state of residence. Secondly, the second complication that has to be considered is partnership agreement flexibility. As I alluded to earlier, New York and California have special rules wherein residents and non-residents are taxed on different bases with respect to apportionment or unapportioned income. As a result of that, if the expense is shared equally amongst the partners based on their units or based on their profit percentages, you could end up in a situation where one member or partner ends up bearing a disproportionate share of the pass-through entity tax when you compare it to the amount of credit that they're receiving. The states, generally speaking, have enumerated rules that dictate how the credit needs to be allocated amongst the partners and members. And so you really need the expense that's borne by each partner and member to be consistent with the amount of credit that they're receiving in exchange for the expense that they bear. Another issue that's really top of mind is potential federal law changes with respect to the SALT limitation. To the extent that there's a change in the limitation, clearly it may impact whether or not the SALT pass-through entity tax are beneficial to your partners and members. Another consideration is the possibility of having to collect consent from each of your partners or members. States such as Arizona and California require that the partnership or flow-through entity receive consent from a member or a partner in order to include that partner or member in the pass-through entity tax return. And so you'll have to think about what administrative hoops you have to jump through in order to obtain that consent in order to file that return on time. Similarly, there's also an issue of cash flow. It's very possible that the pass-through entity will have to pay entity level tax in addition to withholding taxes with respect to the income that's distributable to a partner or member. And as a result of that, you may have cash flow issues that are greater than you've had in the past, where you've only paid the non-resident withholding or composite taxes that you've become accustomed to paying. And as a result of that, you'll have to think about, one, whether or not you have the cash on hand to pay these taxes, and then two, at what time you'll charge the partners for it or treat it as a deemed tax distribution. Finally, there's the uncertainty around Notice 2020-75 and whether or not it's applicable to all of the state pass-through entity taxes that have been enacted for the reasons that I mentioned earlier.
Well, Jason and Dan, those are very helpful insights. And it's clear to me that a detailed analysis is required in many circumstances, especially if you have partners with different tax profiles or are in a variety of states. So thank you so much for sharing that. If our listeners would like more information, they can search Deloitte.com for an article written around the New York pass-through entity tax. There may be some other information there as well that you might find helpful. And you can also connect with Jason or Dan directly via LinkedIn. In the meantime, thank you so much for joining us, and I hope you continue to be well.